Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we're going to walk through the U.S. market analysis for Monday, April 13th, 2026.
Just so we're all on the same page, this video presents a direct informational narration of the source document.
Okay, before we get into the details, we have to go over the initial risk disclosure. So here it is. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk. All strategies and market views are presented for reference only and do not constitute trading instructions. Any investment decision should be made independently by the reader. Past performance is not indicative of future results, and information contained herein may be time-sensitive.
So here's what's on the agenda for today. First, we'll kick things off with a market action overview. Then we'll dig into some macro data, specifically from the housing market. After that, we're going to examine fund flows and institutional behavior, and then do a sector focus on software shorts. From there, we'll get into some single stock technical analysis before we wrap everything up with our conclusion and outlook.
All right, let's jump right in. Section 1, Market Action Overview. We're going to look at the game logic behind this pattern of Asia session pressure and then the U.S. session reversal we've been seeing.
So, what we're seeing in the market right now is something the source document calls game-driven resilience. It's this interesting cycle, you know? Negative headlines pop up during the Asian session, pushing futures down, but then boom, positive news hits after the U.S. Open and everything reverses. Now let's look at the core observations from the tape. On Monday, April 13th, the Nasdaq Composite actually logged its 9th straight winning session. Pretty incredible. And the Russell 2000, it surged 1.44%, outperforming the big guys, and that was mostly driven by some really aggressive short covering. All of this is painting a picture of a market in a, let's call it a modest melt-up. It's just this passive upward grind where every single dip gets bought up.
And this is where it gets really interesting. This kind of action is just mechanically crushing for short sellers. I mean, think about it. When the market starts to feel like it simply cannot go down, all that sidelined cash and all that forced short covering creates this wave of passive demand. The report has a great analogy for this. It calls it the Sedan-Chair carrying effect. And that really hits the nail on the head, doesn't it? It shows that this rally is much more about liquidity than it is about pure fundamentals right now.
Okay, let's keep building on that. Moving on to Section 2, Macro Data Analysis. Here, we're going to zero in on some stagflationary signals that are popping up in the housing market.
So, the March data is telling a story of divergence, lower volume, but higher prices. Let's walk through these numbers. First up, March existing home sales, month over month, were down 3.6%. That's 3.98 million units when the market was expecting 4.06 million. Then we have existing homes available for sale. That number stood at 1.36 million units, which works out to 4.1 months of supply. That's up from 3.8 months a year ago. And finally, the median existing home price came in at $408,800, and that's up 1.4% year over year. So, what's the big takeaway here? Well, the analysis suggests that when you see sales volumes going down while prices are still going up, it points to some real stickiness in inflation. And this is a huge deal because it really ties the Federal Reserve's hands, constraining their policy options. You know, if inventory keeps piling up while sales stay weak, that upward momentum in home prices could really start to fizzle out. Okay, now let's switch gears and talk about liquidity. Section 3, Fund Flows and Institutional Behavior. We're going to look at the mechanical buying from CTAs and the impact of corporate buybacks.
In this kind of low volatility environment, there are really two big forces acting as a safety net for the market. First, you've got these systematic CTA strategies. These are the big trend-following funds, the commodity trading advisors. Their models are actually forecasting that they'll keep on buying, even if the market just trades sideways or has a small dip. It's a big shift, too. Year to date, they've gone from being massively short to significantly long. And the second force? Corporate buybacks are coming back online. The pre-earnings blackout period ends on April 28th, and authorizations have already hit $5 billion so far this year.
But you've got to keep an eye on some key danger zone levels for these systematic funds. The numbers to watch are 6,739, 6,725, and 6,413. The report really emphasizes that if the index breaks below that 6,740 area, these funds are going to flip from buying to selling. As of right now, the index is about 150 points away from that first warning level, so there's still a bit of a cushion.
All right, let's get a bit more specific now and drill down into one particular area. Section 4 is our sector focus, and we're looking at the extreme short covering wave that's been happening in software.
You know that really popular pair trade, long semiconductors, short software? Well, that's seeing a massive adjustment right now. And if you look at the data here, it's pretty clear that the bearish view on software got incredibly crowded. I mean, software recently made up 60% of all the net selling in the entire IT sector. Net exposure just collapsed, going from 7% at the start of the year all the way down to just 1.4%. And the long-short ratio, it dropped to 1.14, which is an extreme we haven't seen since late February.
Now, this is a really crucial point. The source material is very clear about this. This is a rebound, not a structural reversal. And whether this rebound has legs, whether it can last, that's going to depend entirely on whether real money demand shows up to take the baton from all this initial short covering.
Okay, time to get even more granular. Let's move into our fifth section, single stock technical analysis and high probability position tracking.
Let's run through some key levels for a few of the core software names. We'll start with Microsoft, ticker MSFT. For them, 430 is the key level to watch. If it can hold above that, it pretty much takes any near-term downside risk off the table. Moving on to Oracle, the stock has found a nice base in the 137 to 143 range. Key resistance is a ways up between 164 and 176. Next, we've got PLTR. Its bottom support is between 12.2 and 12.6, with two big resistance zones overhead, one at 136 to 145 and another at 151 to 161. And lastly, for Adobe, ticker ADOB, you're looking at downside support at 224 with a pretty dense supply zone above between 235 and 264.
All right, now let's look at storage and semis with SNDK. This is interesting because it was just formally added to the NASDAQ 100, and that's creating a ton of passive institutional demand. The pattern is described as a northeast winds uptrend, which is pretty vivid. The market has also bumped up its fiscal 2027 earnings per share expectation to around 90. For support, the strong zone to watch is between 690 and 753.
So, what's the strategic play here? Well, the analysis offers some pretty clear advice. Before we see a real, confirmed structural reversal, the prudent move is to build your positions in pieces and tranches and keep your total exposure in check. The report specifically advises against aggressively chasing these moves right into those heavy overhead supply zones.
And that brings us to our final section, where we'll pull it all together. Section 6, Conclusion and Outlook. We're going to synthesize the margins and key pivot levels of this whole game-driven rally.
So what are we looking out for the near term? Well, the market is likely going to keep this melt-up profile going at least before Friday. Wednesday and Thursday are seen as the key windows to watch for any signs of momentum exhaustion. Now, the really crucial technical level to watch is 6980. That's the market's gamma flip level, the point where options market dynamics can just pour fuel on the fire and accelerate price moves. If we get above that, the upside could hit a kind of pressure-free vacuum zone. And looking longer term, the report flags a potential risk, falsification pressure around AI monetization. Basically, will the reality match the hype? That's a question for early 2027.
The report really boils it all down to a single discipline, concluding with this. Continuously tracking the relationship between fund flows and momentum drawdowns is the only discipline for navigating the current game-driven market. And that leaves us with one final big-picture question to think about. Will AI monetization validation face that falsification pressure in early 2027? And to close out, here's the final professional risk disclosure. This document is provided solely for informational and research purposes and does not constitute investment, financial, or trading advice. The author is not acting as a registered investment advisor. Investing and trading involves substantial risk, including the possible loss of principal. Any investment or trading decision is undertaken solely at the reader's own discretion and risk. Past performance is not indicative of future results, and information may become outdated without notice.